Hi forex traders, welcome back. My name is Francis, and in today's episode I'm going to show you how to take an entry using a very powerful entry model. This entry model is one of the entry models I have taught my VIP students, but I'm going to teach you for free because I want all of you guys to make progress in your trading journey, because when all of us succeed, that's where the real impact is. Okay, so I want you guys to pay attention to this specific entry model. There are many other entry models, but this one specifically is going to impact your trading positively. And for those of you who are in drawdown in your proprietary firm challenges, you can use this strategy to come out of drawdown and possibly even scale up your evaluation using this strategy. Those of you also who are swing traders, those of you who like to do swing trading, you are going to enjoy this strategy because you can literally look out for these signatures on every time frame: the daily, the 4 hour, the 1 hour, and for day traders you can go down to 15 minutes and even 5 minutes time frame to look for this entry signature. Okay, because some of you have asked me these questions: how do we take an entry, especially after we have done our directional bias analysis? Most of you are still very confused on how to execute a trade, and this is why this video is coming to you. All right, but you must put to note that institutional order flow or the higher time frame directional bias will always be the driver on where the institutions are going to trade into. Okay, because the liquidity is residing on the monthly, the weekly, the daily time frame, but because price is fractal, price forms from a lower time frame into the higher time frame liquidity zones, so we call them the higher time frame draw on liquidity. Okay, so quickly, there are two types of this entry model. The name of the model is called institutional order flow entry drill. You've heard me mention this a few times, but I haven't showed you specifically how this looks like on the chart. And ICT has mentioned this too, but I'm not sure ICT has showed you guys on YouTube what this looks like. Okay, so it's called institutional order flow entry drill, and I have classified them into two forms. We have the institutional order flow entry drill type 1 or IOFED type 2. All right, the word IOFED is the abbreviation for the full name, institutional order flow entry drill. Okay, so the type 1 is a scenario where you have, for example, price has been bearish. All right, then we have a shift of market structure. Price creates a fair value gap around this region with an old wick in between that fair value gap. So that's the type 1. Fair value with an old wick in between it, or old high in between it, or old low in between it. That is institutional order flow entry drill type 1. All right, so let's say, for example, we have this shift of market structure, then we have, for example, fair value gap here with an old low in between. So you can see this old low in between. In this case, the wick is what we are paying attention to, and the old high in between this fair value gap, that is the wick of the candle here. All right, this is called IOFED type 1. And what is the entry pattern? The entry pattern is that you are going to take a long position at the low of the fair value with your stop loss below the low of the candle that forms that fair value gap. Or if you are selling, you are going to take a shot at the high of the fair value with your stop loss above the high of the candle that forms that fair value, and your take profit will be the next drawn liquidity on the time frame that you are taking that trade, or the higher time frame drawn liquidity. All right, guys, so if we are taking this buy, we'll take it from that the low of that fair value right there. You can see that, and to the drawn liquidity. But in a scenario where you have a wide range fair value gap, we would like to take 50% of the fair value. It's called consequent encroachment. Once price gets to that level, we will take our buy. Or if we measure the distance from that low to the stop loss, if it's not more than 20 pips if we are doing day trading, all right, or 40 pips if you are doing swing trading, 40 to 50 pips, then you can take your buy at that level, okay, or take your shot at that level. So this is IOFED type 1. Let's look at the IOFED type 2. The IOFED type 2 is market condition where price creates a previous displacement, then creates a new displacement, creating fair value gaps on the left and right of that price action. So you have a fair value gap here that was violated by this current displacement. This current displacement violates this fair value gap and creates another fair value gap here. This is called IOFED type 2. We like to take our entry once price returns to the low of that fair value here, or 50% if the fair value gap is large. We like to take a buy from that level to the next draw on liquidity. Then if we are taking a short, you have a market condition where price creates that something like this, creates another, then price creates something like this, creating fair value here, okay, that was violated by that bearish pricing, thereby creating a new fair value by the right. So it's two fair value gap, one by the left, one by the right. That is IOFED type 2. Once price returns into the high of that fair value, or 50% of that fair value gap, we like to take our entry into the next draw on liquidity. This is what institutional order flow entry drill is. Let's quickly go to the chart and let me show you just a few examples, and I'll leave you guys to do your analysis, do your study, and be able to see these things for yourself, because obviously you have to train yourself to see these things. So this is the 4-hour time frame, and imagine that I was doing swing trading and price has been retracing bearishly after that bullish expansion here. Price traded down into that bullish mitigation block around that level right there. Okay, that bullish mitigation block right here, price traded into that level. Then you have a new displacement to the upside right here, creating a shift of market structure. All right, but you can see that there is a block right there, but price never got to that order block. Why is it so? Because there is an institutional order flow entry drill type 1 model right here. Okay, so let's take a look at this. You would agree with me that this is a fair value gap. All right, you can see that this is a fair value gap that was created previously, and then price has an old high in between that fair value gap. This is called institutional order flow entry drill type 1. So if I was taking a buy on this type of signature, something I could do, since I'm on the 4-hour time frame, is that if I don't want too much stress, I could just place a buy here. I could place a buy right there with my stop loss around this level, and the draw on liquidity is the previous high, as you can see right here. That will be the draw on liquidity. All right guys, that will be the draw on liquidity. That will be the draw on liquidity, that old high here, the body of the candle specifically for liquidity, because the body of the candle reflects true institutional pricing. The wicks are broker related. The brokers are the ones inducing that wicks you are seeing. That's why it's different with different brokers. So we are paying attention more importantly to the body of the candles and also to the candle wicks. Okay, so if you measure this, you would see that this is about 40 to 50 pips, 40 to 52 pips, but you end up taking 168 pips. This is over 1:3, and it's a very good trade for me, because 1:3 is a very good risk reward ratio. All right, or you could as well just go down to the lower time frame, 5 minutes time frame or 15 minutes time frame, and look for shift of market structure once price returns into that fair value gap created on the 15 minutes or 5 minutes. You can take that buy from the lower time frame, because you want to reduce this drawdown. You want to reduce your stop loss so that you don't have a wide range SL. Okay, so look at this. Price gave us that swift price movement. Okay, then price retraced back into a fair value gap here in the discount. All right, but you could see that the old wick right here is not exactly in between that fair value gap, so I'm not paying attention to this. Okay, price just retraced into that bullish mitigation and with a fair value gap, and again price continued bullishly. What was the entry model? It was this institutional order flow entry deal. Look at how many pips. This is over 1,000 pip price movement from just this one entry model, not up to 1,460 pips from just this one entry model that you see on the 4-hour time frame. So you will agree with me that this is a very powerful entry signature for swing trading, and even day trading as well. All right, all you need to do is to do your work, do your hindsight study, and you're going to see this working out for you all the times. It hardly fails once it prints out on the chart. So we have another displacement to the downside right here. Price created a displacement. Don't forget, I'm on the 4 hour. Price created a displacement. Then what we have here is a fair value. Okay, we have a fair value gap here. Then we have another fair value by the left right here. We can call it implied fair value gap, 50% of the candle wick of the first candle that forms that fair value gap. Let me show you. Do you see this candle? 50% of the wick, 50% of the wick of the third candle. That's a fair value gap. So it's called implied fair value. So fair value gap by the left, fair value gap by the right. Look at how this is IOFED type 2. Look at how price traded back into it at that level and gave us that expansion lower into that bullish order block that was created here. So this would have been a trade. This would have been a trade from that level. That will have been a trade. So again, you ask me, how would you reduce your stop loss? Go to the lower time frame, 5 minutes, 15 minutes, look for shift of market structure bearish, and you would be able to get the entry on the lower time frame. And look at this. Look at this, guys. This is a trade. And price again returned back into that IOFED. This time around 50% of this fair value gap. You can see that. If you go down to the lower time frame again, you would see an entry, shift of market structure, then creates another expansion lower. So if you miss this again, patiently, you are searching for IOFED. Look at this. Another fair value gap was created here. Fair value gap. Do you see that? Then another fair value gap by the left. This is called IOFED type 2. Fair value by the right, fair value by the left. Look at how price traded back into that level. Look at how price fell massively without going back to that order block. Do you see that? You will now see that there are reasons why you are missing a trade. Most of you come and you say that my trade has not traded back into the order block. That's why I missed it. It just kept going down. This was because there is an institutional order flow entry drill at that level. Look at it. I told you, if you took the entry at the low, your stop loss is above the high of the candle that forms that fair value. So this candle here, you can see the high of that candle, that should be your stop loss. Fair value by the right, fair value by the left. IOFED has been printed. Price fell massively. Look at this again. Price gave us another IOFED type 1. It keeps interchanging between IOFED type 1 and type 2. That's what institutions are doing. You can see fair value with an old wick in between. I know you're going to like this strategy, especially if you take out time to do hindsight study. Train your eyes to see this. You will like this, guys. So once you see this and price trade into that level, go down to your 5 minutes, look for that entry model, displacement, with that creates another fair value, or even that IOFED on the 5 minutes or 15 minutes. Did you see? This is also another trade that you would have taken. All right, guys. So I'm just going to be showing you the most obvious ones. All right, so that you take our time to go and study again. Look at another fair value gap here by the right and fair value gap by the left. IOFED type 2. Fair value another by the left here. So you have another here, you have another by the right. That is a trade because this is over 90 pips and you are risking just 30 pips or 36 pips. Okay, 90 pips. If you, in scenarios like this where the fair value gap is wide, I told you 50% of the fair value would be your entry, or just go down to the lower time frame and look for your entry signature. Simply put shift of market structure, return to fair values, or return to that fair value gap that was created on the 5 minutes. Okay, so look at another example. Price took out the high here. I'm just showing you this without doing institutional order flow because by now I know that you guys understand how to determine the daily bias on the higher time frame Okay, watch my previous videos, my commentaries. You see how I used to do top-down analysis from the monthly, weekly, daily. Once you do that and you know you are bullish or bearish, if you are a swing trader, come to the 4-hour time frame and look for this entry signature. If you are a day trader, come to the 1-hour time frame and the 15 minutes time frame and look for these signatures IOFED. Okay, so we have displacement lower right here, create fair value gap by the right and fair value by the left. Did you see this? If you pay attention very closely, you're going to see that there is a fair value gap right here by the left. It was hidden by the institutions. They know what they are doing. Alright, this fair value gap that was violated. Price went back into this range, 50% of the range. You can see consequent encroachment. You use your Fibonacci to measure between the high, to the low of the entire fair value gap. 50% of it is called consequent encroachment, and that's where institutions traded into, and you will be shorting around that level, or simply go to 15 minutes or 5 minutes, look for that shift of structure or new displacement, and you short from that level. Stop loss above the high of the third candle that forms that fair value gap, this candle here. So you will have taken an entry there. If you missed that, look at this again. Price creates another fair value gap, old week in between. Old week in between, price returned deeply into that, so you would have to look for lower time frames, entry model before you short at this level, and price keeps doing these things again and again and again and again. Look at another one, fair value gap, old week in between. So you can see that this concept is almost on every chart. Go down to the 1 hour, 15 minutes, do your insight study, and let me know your feedback in the comment section of this video. Let me know if you enjoy the strategy. Let me know if you are making money with the strategy, and if you make enough money, you can join our mentorship community where you can get to see my weekly and daily trade forecast. You can get to interact with other community of traders who have like minds. And also, if you are looking to get funded with a proprietary firm, I have attached a link in the description of this video where you can register and get yourself an account with this proprietary firm, Funder Pro. Start trading so you start making money as fast as possible. Guys, until next time, I wish you good luck, good trading. Stay safe.